You can read order flow for free directly from a candlestick chart without paying for expensive software. Watch this. Price compresses. Aggressive buyers break the level, and the retest cannot push back through it. Then an imbalance continues the move. It's that simple. Look at this candle. The lower wick is almost twice the body length, and it's poking into a level from yesterday. That wick is a receipt. Somebody tried to push lower, they got shut down, and the close tells you exactly who won. If the body lands in the upper third of the range, buyers won the auction, period. Now the body. The close location matters way more than the color. A red candle that closes in the upper third of its range is actually a bullish print because sellers had control for a moment and then lost it. Retail sees red and panics. You see the close location and read it for what it is. Then the speed. 3 candles with tiny wicks and big bodies means institutional momentum. 4 candles with long wicks on both sides means a fight. And fights are noise. You don't trade noise. Here's the part that flips the whole frame. You're not reading volume, you're reading intent. Volume tells you what already happened. Intent tells you what's about to. So binary rule, copy this down. If the candle closes in the upper third of its range after sweeping a level, buyers won, and I'm looking long. If the candle closes back inside the range, it just broke, sellers absorbed, and I'm looking short. Middle close is noise. Now one of these 3 receipts lies to you almost 4 times out of 10. You'll see exactly which one when you understand liquidity. Those receipts work because something forced that rejection. That something has a name, and it is the fuel for every receipt you just learned to read. We call it liquidity. In the retail world, you were taught that equal highs are strong resistance. You were told that the more times a level is touched, the stronger it gets. That is not just wrong, it is dangerous. To an institutional trader, equal highs are not resistance. They are a magnet. They are a pile of money sitting on the chart. Every retail trader who sells at resistance puts their stop loss right above those highs. Those stop losses are buy orders. If a bank wants to sell a massive position, they need people to buy from them. This is the fuel map. Price does not move because of patterns. Price moves to find liquidity. It moves to hit your stop because your stop is the fuel for their entry. This is not a theory. This is psychology made visible. The textbook says, buy the breakout above equal highs. The chart says those equal highs are a magnet for stops, and the first poke is always a trap. If there is no untapped liquidity nearby, there is no reason for price to move. If I do not see equal highs or obvious swing points within reach, there is no fuel. No fuel means no trade. My decision rule is simple. If I cannot see where the losers are trapped, I am probably the one getting trapped. I only take a trade when I can point to a pile of stops that price is about to hit. There is a name for what happens when price pokes the high and reverses. It is called a liquidity sweep. Here is what it looks like on a chart before it prints. I am looking at the London session on pound dollar. Notice these 2 highs right here. They are almost perfectly equal. Most traders are marking this as resistance. They are waiting to sell the third touch. I am doing the opposite. I am marking this as a liquidity pool. Now watch as the New York session opens. Price starts to aggressive push toward those highs. Look at this candle. It pierces the highs by about few pips. Retail traders are buying the breakout. But look at the close. The candle closes all the way back down, leaving a long wick at the top. This is our first receipt. It is an absorption receipt. The sweep told you a reversal is cooking. But here is where beginners get smoked. They enter without a signature. Watch what happens when they do. Retail traders see that big wick and they instantly hit sell. They think they caught the top, but then price grinds sideways and hits their stop before finally dropping. They had the right idea, but they entered without the institutional signature. That signature is an imbalance. This happens when price moves so fast that the buy and sell orders do not have time to match up. On your chart, it looks like a big candle with little wicks, or several big candles. This leaves an imbalance. What used to look like momentum now looks like an unfilled order trail. Retail chasers see a massive red candle and they try to sell at the bottom. They are chasing the impulse. But order flow readers know that price almost always comes back to fill that imbalance before it continues. Institutions leave these gaps when they move big size. They often return to those levels to fill the rest of their orders. I lost hundreds of trades because I was always the last one into the party. Remember this, the imbalance is the trap for chasers and the entry for readers. If the imbalance follows a liquidity sweep and points in the direction of the reversal, I am interested. I place my entry at the 50% mark of that imbalance. Binary rule: if the imbalance follows a liquidity sweep and points in the direction of that sweep's reversal, entry at the 50% retrace into the imbalance. If the imbalance fires against the prior sweep, it's a distribution trap. Pass it. Imbalance in trend direction is continuation. Against the trend, it does the exact opposite. Now remember the receipt that lies to you. It's the wick. I traded every major wick I could find for several months. Every long lower wick looked like rejection. Every upper wick looked like a top. But my equity curve looked like stairs going down. The problem: every wick looks like a rejection in hindsight, but when you trade them live, half of them fail. This is the mistake that kills most order flow beginners. They see a wick and an imbalance, and they take the trade, but they forget the most important rule: location. A wick in the middle of a range is just noise. It is just the market moving around while traders eat lunch. The identical wick at a prior session high, right after a sweep, is a professional trade. It is the same candle, but it has a different address. Every signal we have discussed has one job. It is there to confirm a location. If you do not have a pre-marked level underneath the signal has no meaning. I only look for these setups at session highs, session lows, or previous day levels. If price is in the middle of nowhere, I do not care how many wicks it prints. Most traders think they need more indicators. They add a MACD, they throw a moving average. They are trying to fix a location problem with a momentum tool. But the rule is simple. If the signal prints at a pre-marked level like a session low or equal highs, it is valid. If it prints mid-range with no structure nearby, I skip it. I am watching the New York Open on the NAS 100. Price is trending down. I see a set of equal lows forming right here. This is my fuel. Now watch the first sweep. Price pokes below the lows. It leaves a wick. Some traders are buying this right now. But look at the next candle. It is tiny. There is no imbalance. I am not touching this trade. The imbalance is the filter. If the big money was entering here, we would see an aggressive move away from the level. Instead, price just grinds sideways. This is a red flag. I stay out. Here's the lesson nobody tells you. The first sweep isn't always the trade. The filter is the imbalance. Pay attention here. Two identical sweeps at the same level, completely different outcomes. The second one paid because the signature, the imbalance, showed up. Look at this. Price sweeps the lows again. But this time is different. Look at that candle. It is a massive bullish impulse. It leaves a clean imbalance. I am marking the 50% level of that candle. Now I wait. Price starts to pull back, and as is dipping into my zone, I enter long. My stop loss goes just below the sweep wick. In the ideal scenario, price hits the zone and takes off immediately. It does not even look back. That is a 3-hour trade, and it only worked because we waited for the signature and the location. Some rapid-fire examples. Pay attention. Gold on the 1 hour. Price pierces the prior day high. Exactly. The body closes back inside yesterday's range. This is a confirmed rejection receipt, so a short trade is valid. 1 wick plus a pre-marked level equals a high probability entry. Now S&P 5-minute. Look at this massive bullish impulse. It leaves a clean imbalance. A retail trader would chase this. But look at the left side of the chart. No liquidity was swept. There was no fuel. So price comes back, fills the gap, and then keeps crashing. This is a pass. Signal needs fuel, or it is just a trap. Another one, Euro-dollar 15-minute. We have equal lows. Price goes through them by a few pips and then snaps back. This proves that equal lows are a magnet, not support. It closes back above the level with an imbalance. This is a valid long trade. Now imbalances and liquidity sweeps are a solid foundation for seeing institutional intent. But how do you actually find the exact areas where institutions are doing business? Well, you read the auction. This is auction market theory, and it changes everything. This is your first insight. Every chart is only asking this. Where is price fair? Where is price testing unfair prices? And did the market accept or reject that test? Pull up any 5-minute chart. Don't even start with trend lines or with a breakout level. Start by asking where price keeps coming back. That area is the market's comfort zone. Now watch what happens when price leaves that zone. If it leaves and stays out, the market is accepting a new area. If it leaves and snaps back inside, the market just rejected that move. That one difference changes everything. That is auction market theory without the boring textbook version, and it will completely change how you day trade. Price shows you where it feels comfortable, then it tests away from that area. Your plan is to trade only after you see whether that test holds or fails. So before trading any move, you first find where price is actually fair. The mistake starts when you draw one perfect line from one clean wick and treat it like the whole market must respect it. Look, price rotates inside the same box for 90 minutes. It pushes up, falls back, pushes down, and comes back again. That 90-minute area matters more than 1 or 2 wicks because most of the trading happened there. I mark the full zone where candles keep closing and pausing, not the wicks. This is the hidden edge. You don't need to predict the next candle yet. You only need to know where the market is comfortable. That same chop you wanted to avoid is actually giving you the most important clue. This is what auction traders call fair value. It simply means the market is comfortable trading there. Now watch the middle of that zone. Price is sitting right inside value. You never want to buy or sell there. There is no clean edge. If you buy in the middle, you're buying where sellers are still active. This is the fair value rule. If price keeps rotating inside the same area, I treat that area as value. Now that value is marked, the real trade is not inside the zone. The real trade happens when price tries to leave it. Look at the top edge of this 5-minute range. Price taps it, pulls back, and taps it again. But it still cannot build above it. That edge is giving you information the middle never gave you. Inside the middle of this 40-minute rotation, Every candle is surrounded by buyers and sellers fighting in the same area. At the edge, the question becomes clear. Are buyers strong enough to do business higher, or will price get dragged back into the old box? The middle is where traders force trades during that rotation. The edge is where the market gives you a verdict. When price reaches the top of value, the market is asking, are buyers willing to pay higher? At the bottom of value, the market asks, are sellers willing to sell lower? When you day trade, this first test looks tempting, but the close gives it away. Price pushes into the top edge and breaks above the box. But the next candle falls right back inside value. That is not a clean long. This second test starts the same way, but it refuses to fall back. Price breaks above value, closes above it, pulls back, and still holds above the old edge. Now buyers are not just poking above the level, they are starting to build business higher. This test outside the fair area is what auction traders call price discovery. Price is discovering whether a higher or lower area is fair. But a test outside value is not enough. The trade only appears after the market gives a verdict. Watch this breakout candle before you trust it. It breaks above a 90-minute range and looks strong. But I am not buying yet, because one candle outside value is only a test. Price breaks above the top edge and pulls back. I am watching the old edge now. If price falls back inside old value, the breakout loses its meaning. But here, the pullback holds above the old box. I enter after that hold. My stop goes behind the accepted area. My target is the next liquidity area above, which means the next obvious high where other traders may have stops. You want to see price pushing higher to start building above the old box. That confirms the new value area. This is called acceptance. The market tested a new price, stayed there, and started building value in the new area. This market looks even stronger at first glance, but watch the pullback. Price breaks above value, then comes back and closes inside the old box. I am not long anymore. The verdict failed. This short setup looks wrong to beginners because price is already too low. But that is exactly why it matters. Price breaks below value, holds below the old bottom edge, pulls back into it from underneath, and rejects it. That gives me the short version of the same idea. So binary rule, if price breaks outside value, holds outside, and the pullback does not fall back into old value, I look for continuation. If price falls back inside old value, I don't take the continuation trade. But the same move that looks strong can become the most expensive trap if price does not get accepted. Watch this breakout. Price leaves value with a big green candle, and it looks strong enough to pull buyers in immediately. A beginner day trader buys the close because the candle looks powerful, but buying every candle that leaves a box is not trading. That is chasing a candle with a credit card. The next candle wicks higher, stalls, and closes back inside value. That changes the whole story. Speed felt like proof, but the market just showed the opposite. The stop lesson is even cleaner. The trader buys above the range, places the stop under the breakout candle, and gets hit when price snaps back inside. That loss was not caused by bad luck. The entry happened before acceptance, and now the old value area becomes the magnet again. The mistake is buying the move before the market gives the verdict. The fix is waiting for price to prove it can stay outside value. Once price returns inside value, I stop looking for continuation. I start looking for a move back toward the middle of value, then possibly the opposite edge. Note this down. A failed breakout is not just wrong direction. It is an auction failure. Price tried to live outside the fair area and got pulled back. This is called rejection, or a failed auction. Price tested outside value, but the market refused to keep trading there. If price leaves value and cannot stay there, I reject the breakout idea. If price returns inside value with a clean close, I target the middle or the opposite side of the value area. Now, a fast move above value creates the next decision. Look at this move above value. Price breaks out with 3 large candles. I don't see slow rotation, and you don't see much overlap between the candles either. That tells me buyers are rushing price higher. No balanced trading happened. This is what traders call imbalance or inefficiency. It means price moved through an area with very little two-sided trading. Look here. This first imbalance holds. Price pulls back into the top part of the fast move, but it stays above old value. I like that because the market moved fast, then refused to return into the old fair area. This second imbalance fails. Price makes the same fast move, fills the whole gap, and closes back inside old value. That kills the breakout idea because the fast candle was only a test. So the key question is not whether an imbalance exists. The question is whether price stayed away after creating it. This is the hidden edge. Imbalance only matters when it connects to value. If it forms away from value and price holds beyond it, it can support continuation. If price fills it and accepts back inside old value, the continuation idea is dead. But advanced traders know one more thing. The same setup changes depending on the auction type. Look at this first session. Value keeps forming in the same place, and I can see price failing on both sides of the box. Price moves above the box, rejects, then returns inside. Then moves below the box, rejects, and returns inside again. That is a rotating auction. I don't chase those edge breaks because the market keeps coming back to the same fair area. This second session gives the opposite clue. Value forms, price breaks higher, then the next pause forms above the old value area. After that, price builds value even higher. The fair area is moving up. That is a trending auction. The same breakout can work beautifully on one day and fail badly on another because the setup can stay the same while the auction changes. In a rotating auction, I don't want to chase every edge break. I want to be careful at the edges because the market is proving it likes the center. In a trending auction, I don't want to fade every breakout. I want to favor continuation when price accepts outside old value. Binary rule. When value stays in one area, that is a balanced market. When value keeps shifting, that is an imbalanced market or a market in price discovery. If value keeps shifting in one direction, I favor continuation. If value stays flat, I favor rejection at the edges. Now let's flip it into a full day trading plan. Open the chart and find where price spent the most time. That is your working value area. Then wait until price tests above or below that area. Don't trade the middle. The middle is where clean decisions go to die. Now the verdict matters. If price accepts outside value, you plan continuation. If price rejects and comes back inside value, you plan the return through value. Once you can read value like this, the next upgrade is making the value area more exact with VWAP. VWAP shows where the session's fair price is forming in real time. That's your next video. And this is exactly the kind of setup we break down inside our academy. See you inside.